The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A bet on a more business-friendly White House propels stocks to their longest win streak in just about 2 decades. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
I'm Alex Steele. We're kicking off to the closing bell. Let's party like it's 2004.
All right.
I do not remember that year, but anyway, that's what the S&P is doing. We're looking at 9 straight days of gains. We have not seen that since November of 2004. The S&P up 1.5%. I do want to point out, it is still tech-led to some extent. If you take a look at the move we've seen since April 2nd all the way till now, it's really tech that's been driving and leading the way there. Think of things like Palantir and ServiceNow, also Vistra, which is that AI data center demand. Dow Jones Transport, though, up 3.5%. And I say that, Romaine, because today we're seeing all portions of the market rally. The one loser is the bond market, 13 basis point higher on that 2-year yield.
But this is a broad-based rally here, and it really gets to this idea of the tamp down in trade rhetoric. Quite frankly, it's about trade deals. Even with trade pain, that still beats trade uncertainty, even without the specifics. At least those are the words of Round Hill Financial's Dave Mazza, a sentiment that is actually being echoed by several folks out there on Wall Street who point to this 9-day, 10% rally in the S&P as testament. A rally fueled largely by retail buyers, though, who, unlike their sideline institutional counterparts, took a big contrarian roll of the dice after that monster sell-off in early April. And here in early May, it's clearly paid off. Better than feared labor market data reinforcing that trade today, as the U.S. did add 177,000 jobs last month, a show of economic resilience that, when paired with Wednesday's strong consumer spending numbers, that has investors feeling their oats just a bit. Economists, though, they're saying that data might actually be less of a light at the end of the tunnel and more akin to the eye of the storm.
Wall Street should be nervous. I mean, we're not seeing that in markets today, but what we have here is a tale of 2 lags. So there's a lag between GDP growth and employment. Companies don't want to fire people or lay people off until after they see a decline in output. And there's also a lag in the data itself.
All right, so despite that 9-day rally, I mean, you do have the latest American Association of Individual Investors survey showing that bearish sentiment remains unusually high and above the historical average for the 21st time in 23 weeks. And veteran technical strategist Tom DeMark, who, remember, accurately called the market top back in February, says his models now suggest a drop in the S&P below 48.35. That was this year's intraday low, but not before, Alex, potentially testing some of this year's intraday highs.
Yep, I love that. The DeMark indicator, so key. So many people on Wall Street follow that. All right, let's get a take here on what the retail demand is like, because hedge funds were shorting some big tech names like Google and Microsoft into earnings. But guess what retail investors were doing last month? They were buying stocks. So this takes a look at the VOO. That's the $608 billion Vanguard S&P 500 ETF. And that's on nearly $21 billion worth of inflow just that month alone. That's the most we've seen, Romaine. It's 15-year history, the 5th largest amount ever taken in by a fund on a monthly basis. Bloomberg Intelligence was saying the fact that we're seeing that in face of very volatile headlines is a real testament to that retail buying and that buying the dip mentality. And does that continue then when the news gets even better?
Yeah, absolutely. Kind of quite the contrarian bet that's clearly paid off. It'll be interesting to see whether the institutional side follows that lead or maybe there is a turnaround afoot. Katie Nixon joins us right now, Executive Vice President and CIO for the wealth management business at Northern Trust. Katie, great to talk to you again. A phenomenal rally, and I don't want to look a gift horse in the mouth, but this is a pretty dramatic rebound from that sort of anxiety, angst, whatever you want to call it, from the Liberation Day announcement and everything that led up to that. Are we kind of getting back to square one? I know we're not quite there, but does this feel like we're going back there?
Well, thanks for having me, Romaine. And I would say that at least we've unwound some of the things that were creating sort of that high-risk left-tail outcome that we all worried about post-Liberation Day. I mean, I think the walking back of the reciprocal tariffs clearly was a benefit. Now the negotiations seem to be taking place in earnest with Europe. We've got some positive news on China and other major trading partners. And also the data has been surprisingly resilient. I love that you mentioned in the upfront here, the individual investors plowing into equities here. It's sort of watch what they do and not what they say, because we had investor sentiment super bearish, and household survey sentiment also very, very bearish. But individual investors have bought stocks and households have continued to spend. We heard that not just in the first quarter GDP report, but also in the Visa earnings report, where they talked about just the resilience of consumer spending. So I think a lot of the concerns that we had back in early April have been sort of pushed down one by one.
And this gets to a sense then, if we do start to see kind of a reallocation to what was sort of being unallocated to, is the upside going to be as dramatic as I think some had priced in? This idea that we could maybe even start to retest some of the highs, or at least on some of the individual stocks, not necessarily the S&P in aggregate, but the idea that some of those names, particularly the big tech names that have been sold off to so much, that might have been proven to have been premature.
Well, it's been amazing to see the re-rotation, I guess I would call it. You know, coming off the market highs, we had quality outperforming, we had value outperforming. And since the post-Liberation Day rally, it's been, as you noted earlier and Alex noted, it's been momentum and growth and Mag 7 tech names that have bounced back. And I think we're going to continue to see sort of this pivoting between defensive and growth as we wade through what will be doubtless a very uncertain environment over the next couple of months. So I think we could test the highs. It's possible we could test the lows. I think we're just going to go through a period of a lot of churn and a lot of volatility for investors.
But I wonder if the buy the dip scenario that many questioned in April, have we now been reconditioned for that? Buy the dip, retail did it, it worked. Therefore, when we get the turbulent headlines, buy the dip.
You know what, Alex, and buy the dip worked this time because the data showed up, right? The fears of consumption falling off, demand falling off. If you think about it, the last couple of recessions, and everyone's been talking about the probability of recession this year, the last couple of recessions were characterized by demand falling off a cliff. So we didn't see that. And so I do think that the individual investor was proved right because we've seen resilience in corporate earnings and we've seen resilience in demand. That story may change as we get more into 2025. We may see consumption start to falter as maybe the labor market weakens, and recession risk is higher now because we've forgotten we still have 10% tariffs across the board. We still have 145% tariffs on Chinese imports. So these are headwinds that we've yet to really feel in the economy or in corporate earnings. And we anticipate that we're going to start to feel those as we get further into this year.
That's such a good point. We just have a base for how bad it can be, but not necessarily where it's going to end up. Where is that safe haven then? I mean, is tech going to be that safe haven yet once again?
It's hard to see. We recommend being broadly diversified. I think the diversified portfolios have won this year, those that have growth and value, those that have tech, as well as a more defensive name. So we recommend staying very broadly diversified as a way to navigate through what will be sort of a volatile and uncertain market. And I will say also, we think bonds are going to play their role in terms of portfolio diversification. We do think the Fed's going to lower rates a couple of times this year, potentially 3 times towards the latter part of this year. So we think the bond market will provide that buffer against equity volatility.
All right, Katie, great stuff. Katie Nixon, have a wonderful weekend. Executive Vice President and CIO for the wealth management business over at Northern Trust, kicking us off to the close here on this Friday afternoon, capping another up week here for the broader market. A lot of that, of course, being spurred by the tamp down in tariff rhetoric, a lot of that being spurred by corporate earnings, and some of that being spurred by economic data. A jobs report that just dropped a few hours ago. A deeper dive into that and some of the positives and negatives. That's coming up next here on The Close on Bloomberg. All right, the latest monthly payrolls report is out. 177 non-farm jobs were created in the most recent month. But when you break down that April report by sector, you can see some cracks from the trade war appearing. Manufacturing, retail, trade, and the federal government sector all saw job losses. And the job gains, well, they were concentrated in education, health, service, and trade and transportation. For a deeper dive into what we learned this morning, let's bring in Lydia Boussour, senior economist with EY. And I am curious, Lydia, on the surface, this does appear to be a labor market that continues to grow. When you break it down into its components, there does appear to be some degree of cooling. How did you interpret today's report?
Yeah, that's right. There is certainly some cooling in the labor market, and you can see that in the jobs report in some of the sectors that you highlighted. Manufacturing, for example, has seen weak job growth over the past few months, but you can also see that in other labor market indicators that were released this week, including job openings. So labor demand has been gradually downshifting. I think the good news for now is that we're not seeing any signs of broad-based layoffs. If you look at the job report this morning, we have job growth averaging about 155,000 over the past 3 months. So the job market was on good footing heading into this tariff turmoil. Now, I think it might have reflected also some of the front loading in economic activity that we saw in the first quarter of the year. So I would expect to see a bit of a downshift in the coming months.
So what I'm curious about, so as we get into those coming months and you start to see a more material impact from trade, what areas of the labor market would be most affected?
I think the goods sector is at risk. You mentioned manufacturing. That's a sector that will likely see further weakness from these headwinds from higher tariffs and also slower global demand. We also have other sectors on the services side, such as transportation, warehousing. These are some sectors that could also see more direct impact from the higher tariffs. But overall, with companies essentially facing this extremely uncertain environment, I think we could see a slowdown across the board, even in some other services, in the other services sector, just because companies are really putting their hiring plans on hold until they get more clarity on the tariff backdrop.
Lydia, are we seeing companies, though, actively lay off because of the uncertainty or just not hire?
For now, we're not seeing broad-based layoffs. I think that's important to stress. But if you look at some of the surveys and if you look at layoff announcements from Challenger, for example, we've seen that creeping higher. Jobless claims this week were also higher than expected. So as you move into the coming months and you start to see the ripple effect from these higher tariffs, we're likely to see, I think, more conservative hiring, but also some strategic layoffs as companies try also to buffer some of the increased cost that they're going to be facing.
What we learned from earnings season is that that's going to take a lot of time. Like the quarter that we saw was actually really good for a lot of sectors and a lot of companies. How long do you think that's going to take? When does that moment happen when we start to see that?
Yeah, so I mean, if you look at the disruptions that we've seen in the first quarter, just look at the GDP report in the first quarter. We've seen extreme disruptions from the tariffs with imports rising 40% on an annualized basis. We've seen also business investments, rising significantly on the back of stronger software investment. There are signs that companies really rushed to front run the impact of the tariffs. Now, when you look at the sentiment data, we've seen plunging economic sentiment, and business surveys are pointing also to more conservative capex spending in the coming months. Hiring intentions from small businesses has also declined. So, in the coming months, as companies, slow down their hiring effort, we're likely to see a slower labor market. Yeah. We're also likely to see higher prices, which are going to put downward pressure on income for consumers. So that's going to lead to slower consumer spending and slower growth.
I am, though, curious, with regard to the sentiment surveys, whether it's on the business side or the consumer side, I mean, we've seen the gap between the sentiment surveys and the actual hard data. And we've been here before. We saw this in right before the recession. We saw this, right before the COVID pandemic. And then, of course, right in the middle of the pandemic, where the actual hard data never actually did corroborate the survey data. And I'm curious if we end up in that situation again.
Yeah, that's right. We've seen that huge decline in consumer sentiment surveys. The key question is to what extent that's going to filter into slower consumer spending and slower activity. I think we're going to see a slowdown. Some of the indication from this survey would point to a dramatic decline in activity. We're not expecting that. So our base case is that the economy is going to slow quite significantly in the second second half of the year. And our baseline is full speed growth, essentially, but the risk in that type of environment is quite high. Any downside risk that materializes could tip the economy into a recession. So a slowdown, but some fragility in the economy.
All right, Lydia Boussour, senior economist with EY, a closer look at the economic conditions on the heels of that monthly payrolls report that came out earlier this morning. Coming up here, a conversation with the CEO of Chevron, Mike Wirth, stopped by the big program to talk about the future of oil prices and the growing demand for energy. You want to hear what he had to say. That's coming up next here on The Close on Bloomberg.
Shares of Chevron are up over 1% after the energy giant announced it was cutting buybacks, also at a pretty solid quarter. Earlier today, I spoke with Chevron CEO Mike Wirth about his outlook on energy demand and the company's deal to buy Hess, plus the company's presence in what he calls the Gulf of America.
We look at long-term views on supply and demand to arrive at our long-term oil price forecasts, and we look at a range of prices. So a project that would take several years to develop, like a Deepwater Gulf of America project, and then would be online for multiple decades, our decision-making is really not informed by the price of the day. It's informed by our view of prices out over the life of that project, which can be multiple decades. And so the impact of the near-term price is really more around short-term decisions on cash management, the balance sheet, et cetera, but not long-term investment decisions. They're really made on a different set of parameters.
Help me understand this one. RBC Capital Markets had a note out that talked about how oil prices need $95 a barrel for you guys to break even after CapEx, dividends, and buybacks, and that's really high. What would you say to that kind of number?
Yeah, I haven't seen that report. We're growing production, as I said. We're growing cash flow. As we move into next year, our break even to cover the capital budget and the dividend will be down in the low 50s. We get beyond that, it'll move into the 40s. And so if you pick any given quarter and do some of this math, you might reach a certain conclusion. As we look forward into the next few years, our break even will be low and going lower.
Let's talk about the next few years. And a big part of that will be the purchase of Hess. Finally, you get a date for arbitration hearing for the end of May. You've had a chance to look at each other's cases. How has your confidence changed?
Well, it really is unchanged, Alex. The contract is very clear in the language of the contract that will be applied in the arbitration. And we've steadily believed that the Hess side of this argument is the proper side of it. And so as we move closer to the date of the arbitration hearing and then a decision 3 months after that, our view really is unchanged. We feel very, very confident that Hess will prevail here.
Obviously, Guyana is a huge asset and would be so great for Chevron. So how quickly could that be accretive to you guys? Like, what would that integration look like?
Well, we've had plenty of time to prepare for
Yes,
integration, and so the teams have been working closely, and we're ready to move very quickly to integrate the two businesses. So once we get a decision, that can happen in a matter of days and weeks, not months or years.
Let's move to another field that has the potential to be a huge growth driver in the future, and that's Tengiz. Obviously, that had a lot of startup issues, but you're finally running at the same time that Saudi Arabia is trying to enforce quotas for OPEC Plus, which is in Kazakhstan, which is where Tengiz operates. Have you had any talks with the government about having to pare back any production?
Well, we've got a long history in Kazakhstan, and as you say, the project we just completed has been underway for about a decade. It's taken that field's production capacity up to essentially 1 million barrels a day. We've had it running at those levels or close to those levels here during the first quarter of the year. So I've had a chance to speak to the president of the country about that. We don't get involved in OPEC Plus discussions, and so I don't know what is going on there. But I can tell you that our long history in the country has been good for the Republic. It's been good for the investors in the Tengiz field. And those barrels are very high value barrels to the Republic in terms of the revenue that they generate. And historically, they have not been subject to any cutbacks when we're in circumstances where OPEC Plus might be looking to make some of those decisions. And so I'm not aware of anything that would result in us being asked to produce less there.
You make long-term capital decisions, like you were talking about with Gulf of America, for decades to come, right? So the oil price today means a little less than the oil price in the future. What is your future demand outlook as tariffs seem to rewrite the global economy?
Well, the population of the planet continues to grow. The number of people that live a developed world lifestyle is growing, but is still relatively less than those who don't yet have the quality of life that those of us in developed countries can take for granted. And so demand for energy will go up. Demand for all forms of energy will go up over the coming decades. And oil and gas will continue to be a vital part of the global energy system, even as we see other types of energy grow as well. The thing in oil and gas that's always important to bear in mind is oil fields decline over time. So production decreases every year from existing fields, and it requires investment to maintain production even at steady levels, let alone to meet any incremental growth. And so the opportunities for companies that are capital efficient, that are very disciplined in how they run their business, to continue to supply the energy the world needs and create returns for shareholders will exist long, long into the future.
And as we've seen, it's more a rig cutting issue with, say, smaller companies rather than larger companies like yourself. Something that I keep hearing, though, a lot about, Mike, is what happens to NGLs. So overall, liquids, in particular when it comes to global trade. And as the wells in the Permian or in U.S. shale get gassier, are we looking at a potential glut of NGLs in the world and in the U.S.?
So the U.S. has become a very large producer of natural gas liquids. Propane is a big export commodity now. The U.S. exports ethane as well to markets around the world where these tend to be used as feedstocks for petrochemical production. They can also be used in heating and other applications. And so as trade rules change and trade flows change, that can affect where those flows go. It can affect the netbacks that producers and sellers of these commodities realized.
That was my conversation with Mike Wirth, CEO of Chevron. Of course, this comes in the same day that Exxon reported earnings. Their production profile did quite well because of their M&A from Pioneer Natural Resources, which really boosted their Permian. So is the idea, though, that these companies are still sort of moving forward with their longer term production plans? Yes. And exploration plans. So depending on how big you are. The big guys, yes. Yeah. Okay. Smaller guys, maybe not. Okay. But for how long? I was trying to get for, like, if we stay at like 455 for how long? Like, when do you start to pull that back? We're not quite there yet. All right, coming up, Amazon and Apple's earnings affected by tariff and trade policies. The legend himself, Gene Munster, will be joining us to break it all down. This is Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Boston. And I'm Alex Steele. And if you're long equities, particularly long tech, you're feeling pretty good today with 9 straight days of gains for the S&P. Yeah, absolutely. But it's kind of interesting, too. It's kind of a tale of two cities. You have some of the big tech stocks that are kind of helping to lift this market. And you have a couple of really notable folks sitting on the sidelines today, including none other than Sir Apple Inc. Yeah, take a look at that. Down 4%. All the Mag 7 is up. Granted, Amazon's flat, but Mag 7's up. Tech has been primarily driving the rally that we've seen in the last 9 days, but Apple lagging behind. Here to break it down more for us is Gene Munster, managing partner at Deepwater Asset Management. Gene, that stock down 4% on the earnings risk and the tariff risk. Is that justified, or do we need to re-rate more here?
I think that there needs to be a re-rating higher, and understand why it's down 4%. Maybe taking a step back, is that the March results were better than expected. The June guidance was in line, which debatably is better than expected in this environment. They did not pull forward iPhone revenue because there was this concern that they're going to steal revenue from the June quarter and pull it into the March quarter. And if you gave me that playbook before the earnings, I would say stocks up 4%. But here we are down 4%. And the reason is that the call had 6 questions from analysts that dealt with beyond the June quarter. Now, it's typical that analysts will come up with questions. Usually it's 1 or 2 per quarter, but there were 6 this time. And of course, Apple never talks about beyond the current quarter. And so it kind of left this feeling of just emptiness or loss of direction, I think, in the back half of the year. And I think that's why we have this down 4%. And so at the end of the day is that the company is doing a great job in the current environment. Tim Cook's at the center of that, and he's also going to be at the center of whatever's going to happen in the back half of the year. And so I think investors should ultimately rest well at night knowing that he's at the center. And I suspect that in the weeks ahead, you're going to see the shares recover. But I think that's what's going on with the stock today.
And so how much of that do you feel like is tariff related and that $900 million hit versus basic things like China demand and an AI strategy?
Well, I think the tariff hit is what's driving the concern. And I think that ultimately is that we don't know what the pricing impact is going to be in terms of the cost of inputs. They talked about this 4% hit to operating margin, which is pretty modest given everything that's going on. And then we don't know what the demand environment is going to be, because if in fact prices go up, maybe consumers pull back. And so to answer your question, it really is about tariffs. I can give you another quick point. That there were 7 questions. I mentioned the 6 that were related to after the June quarter. There were 7 questions on the call that were related to tariffs. And so, it's very rare you get that many questions. I would say this about Apple Intelligence. That's been something that's nagged me over the past 6 months. I've been disappointed in it. And I'm one of the people who called a super cycle. I fully expected that at this point, we would see iPhone 16 demand growing at 8 to 10% a year, off of a 1% growth last year. I fully expected that based on these Apple Intelligence features, and it turns out that they didn't get them out in time. And Cook did not give a time frame in terms of when we should expect the personalized Siri, which is the real substance of what's going on. The company has said that's early next year. And so I think that, said another way, I think that this Apple Intelligence question is an important part of the conversation. It's a distant second to what people are thinking about relative to tariffs today.
Yeah, certainly so. I do want to pivot to Amazon as well, because a lot of some of the issues that we had about Apple coming into this earnings season, we also had about Amazon, though the shareholder reaction seems to be decidedly different. Is there a sense here that whatever could potentially hurt Amazon when it comes to trade and tariff policies, that it's going to be mitigated, or at least they will be able to manage it better than some of their big tech peers?
I think so. They did a good job on the call last night of explaining why they're best positioned in a tight environment. They talked about the 2 million items that they have that are lower priced on the platform, that they can start to essentially gain shares from other retailers. And so I think that, are they better positioned? Maybe said a different way, is Apple probably is the least well-positioned, is the worst position amongst the Mag 7, just given they have China exposure on manufacturing and 15% of the revenue. So Amazon has less, so relative to Apple, I think you see some of that piece. I think something else that resonated me with Amazon's results, again, this is pick your adjective about how difficult of a macro we're moving through here, but they effectively guided revenue up by 2% versus the street for June. And now by the letter of the guidance, it wasn't there, but they usually hit the high end of the guidance. And so when you factor that in, this is a really like an impressive guide from Amazon. I think you're seeing that stock's not in line with the NASDAQ today, but it's still doing well.
What were your general thoughts, though, about the CapEx spend? We came in and there was a lot of concerns, particularly because of some of the reporting around Microsoft, that the idea that we would see the CapEx spend and the investments in AI and data centers wane a little bit. Based on what we heard from Meta, that's not the case. Microsoft, I know they trimmed a little bit, but nothing dramatic. And Amazon's CapEx does also appear to continue to be on the upswing.
It does, and maybe let's just package the last 2 weeks together in one very simple takeaway, is that the CapEx by the hyperscalers is intact. There was some question after DeepSeek. There was some question around tariffs. This is fully intact. And my sense is why that's so important is that we are still very early within not only just the AI infrastructure build out. That might seem like I'm disconnected there, but I still believe we're very early in that. And then separately, we're obviously early in terms of the applications. And so I think of the AI as kind of the rising tide underneath the tech trade over the next couple of years is in great shape after what we heard in the last couple of weeks.
All right, Gene Munster, one of the best in the business, managing partner
Thank
over
you.
at Deepwater Asset Management. A closer look at those big tech earnings as we take a look at the Mag 7 closing out gains for a second straight week. When we come back, we're going to take another look at, well, I guess the flip side of the tech trade and Block. That stock actually breaking down in a big way after reporting weak results and lowering its profit guidance. Mark Palmer, senior equity research analyst over at Benchmark, joins us in just a bit. This is The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start off with Airbnb, a downgrade at Wedbush to neutral from outperformed, a trim of the price target by $15 to $135. Despite Airbnb beating earnings and sales estimates, the analysts raising concern about the company's worse than expected outlook, and that commentary suggesting emerging evidence of a U.S. travel slowdown. The shares nevertheless getting a modest bid on the day. Next in line, Reddit. Bernstein raising its recommendations on the social network to market perform and increasing its price target to $130. The firm says they're, quote, tired of getting it wrong on Reddit and that they're encouraged by the company's earnings performance. Unfortunately, they got it wrong today. Shareholders bidding it down 3.5%. And finally, Block. Benchmark downgrading the digital payments company to hold, removing the price target altogether. Benchmark says the earnings results show stagnation in active users of Block's Cash App. It says that's even more concerning than users reduce spending on their Cash App cards. Those shares having one of their worst days going all the way back to the onset of the pandemic in 2020, and those are some of our top calls. We do want to stay with that last call because the analyst behind it joins us right now. Mark Palmer is senior equity research analyst over at Benchmark. All right, let's start off with the Cash App trends. Was this just about the number of people dropping, or was it about the amount of money that they were spending or transferring declining?
It's really both, because Cash App typically has a very strong first quarter. And that's a function of users getting their tax refunds, putting them onto the app, and then spending those funds using their Cash App cards. This is something that's happened for the past few years. This year, that didn't occur. The inflows to the app did not occur. The spending was curtailed in particular categories. The discretionary categories, travel and entertainment, particularly got hit. So yes, there was a spending issue on the one hand, which is a bit concerning because this traces back not before we began to worry about tariffs and whatnot in early April. This is something that started in February. Beyond that, there's the fact that Cash App active users stagnated, went to 0% growth this quarter. This is to us challenging. Because typically speaking, Cash App as a bank account substitute is a vehicle that lower income consumers in particular tend to flock to during times of macroeconomic uncertainty. Good example of that was the pandemic. But now we're seeing it flatline. So we don't think this is simply a matter of a short-term spending issue. We think it's entirely possible that Block, through its Cash App, is hitting its head with regard to its total addressable market. There just might not be as much growth available.
Okay, so if they're hitting their head, the total addressable market isn't what they thought it should be. What are the options here?
Well, what the company is going to do is crank up its marketing spend. It's going to be up 50% from where it was in the first quarter, in the second quarter. And they're really gambling on what's known as Cash App Borrow. This is the means through which the company extends small dollar, short duration loans to consumers. It recently received approval from the FDIC to extend this offering to all of its users across the U.S. And so the extension of credit is really the way that they see a way out here. We're skeptical, quite frankly. First of all, the idea of extending credit to lower income consumers during an economic downturn doesn't seem particularly palatable. But beyond that, there's the fact that the company is guiding now to 12% gross profit growth. That's down from the at least 15% they previously guided to. Even that might be challenging to get to because it's going to require a significant reacceleration, not only in Cash App, but also on the company's Square seller front.
Yeah. All right. Yeah, absolutely, Mark. It's definitely a lot of red flags here. It'll be interesting to see whether management can sort it out here. But the drop today definitely seems extreme. Mark Palmer is senior equity research analyst at Benchmark. Block shares down about more than 20% here on the day. And this gets to the idea, too, Alex. He talks about this idea of basically becoming more of a lender at times when we might actually be seeing economic softness. Is that the right strategy?
Right. And then what are the other options? Like, again, how many Cash Apps are you going to actually have and mess around with? You need Venmo, you need Cash App, you need Zelle, you need all of those. Anyway, obviously that's not getting hit quite hard. The overall market, though, still continues to hold up very well. We're at 15 minutes from the closing bell on this historic day, 9 straight days of gains, historic since 2004.
Historic. Okay.
It counts.
Yeah, historic. Yeah, that's right. Did we print out hats for this and t-shirts?
Yes, they're right over there. We're going to get them in a second. All right, Melissa Brown will be joining us, Managing Director of Investment Decision Research at Simcorp. What do you do with this kind of rally? This is The Close on Bloomberg.
Coming off the market highs, we had quality outperforming, we had value outperforming. And since the post-Liberation Day rally, it's been, as you noted earlier and Alex noted, it's been momentum and growth and Mag 7 tech names that have bounced back. And I think we're going to continue to see sort of this pivoting between defensive and growth.
Katie Nixon kicking us off to the close 50 minutes ago, and that pivot today is certainly to the growth side. While Apple is a big drag on the major averages on the day, you're still getting a nice pop from the rest of big tech, including some big gains out of Microsoft, NVIDIA, and Meta. And
also, we were talking about this earlier, it's not just tech. You have the Russell also up at the highest level since April 2nd. The Dow Jones Transportation Average also up, doing quite well. So at least today, it's broad-based, but back since April 2nd, it has been tech. Palantir, Arista, ServiceNow, and Vistra. Top 4 performing stocks since April 2nd till now. Yeah,
I'm glad you brought up airlines. They're having a phenomenal day. I guess those stocks had really gotten beat up because of concerns about economic conditions. And we've had a couple of economic data points this week that, at least for now, seems to suggest everything's still relatively copacetic.
Relatively okay. Yeah. So it feels like it was really good data that no one wanted to believe.
Yeah.
That's what it winds up feeling like.
All right, as we count you down to those closing bells, those bells now just about 8 minutes away. Stocks looking to end out the week on a high now, a 9-day run for the S&P 500, longest win streak for the benchmark index going back to 2004. Melissa Brown joins us right now, Managing Director of Investment Decision Research over at Simcorp. All right, Melissa, 9 days, and probably more significant than just the 9-day streak, is just kind of this sort of UE that we've taken from kind of the shock and awe that we saw in early April, where everybody was pricing in the worst case scenarios, to now a market that at least seems to have found some degree of comfort, maybe, with what's coming out of Washington?
I think it's some degree of comfort.
Yeah.
You know, volatility remains high, but it's leveled off. So it's not continuing to increase. And so, yeah, I think investors were looking for some good news, and they got some good news. And so they reacted accordingly.
Is there a fundamental reset? And by that, I mean a reset to fundamentals and how people are valuing them, or has that not changed at all?
Well, I think ideally there would be, but we don't really know what the fundamentals are going to be because there's so much confusion out there. Will we have tariffs? Will we not have tariffs? What if we do, what level will they be? And so that makes it very hard. You can focus on fundamentals, but they're slippery. They can change at any minute.
Yeah.
So based on that, we know we're going to get tariffs, and we know they're going to be at least 10%. So we have like a baseline. It's just a matter of how much more after that are they going to be. When you're looking at companies or even sectors, how do you figure out which are best positioned for that?
Well, it's 10%, but we don't know what the tariffs are going to be on China, and I think that's it's a huge trading partner. So it's still hard to figure out which companies are going to be most affected. Are they going to move their operations out of China? How much are input costs going to rise? And so I think it's still very difficult to figure out who the beneficiaries and who the relative losers are going to be.
So if you're looking at a company, you're going to want someone that's diversified, right? Either that's in who they sell to or how they get their products. Is diversification just going to have to be the name of the game?
I think absolutely. I think not only diversification of a company's business, but also diversification in your portfolio, because it's so hard to pick out who exactly are going to be the winners. You really want to be diversified so that you at least have some level of underneath holding you up there.
With regards to using, I guess, more traditional diversifiers, i.e. fixed income, there's been a lot of talk about, what is the proper allocation right now for, say, treasuries or even corporate bonds, given that there's still a lot of uncertainty in that space, maybe even more uncertainty in that space than there is in equities right now.
I think there's a lot of uncertainty in, certainly in the treasury market, because the Fed is kind of on this knife's edge between, are we going to enter a recession or are we going to enter a period of high inflation?
Yeah.
And so it's as hard as it is to figure out what's going to happen with company earnings. I think it's just as hard to try to determine what the Fed.
It's kind of funny too that we're 5 days away from a Fed meeting and we're hardly talking about it at all. It's almost like irrelevant at this point because everything right now is really being driven to some extent corporate fundamentals, but obviously Washington policy. And it gets to this idea that as we get deeper into the year, do you think we're going to get more of a right sizing in what drives this market, that maybe it will be less about what the president is saying and doing and more about the more traditional things that normally drive the market?
Well, I think if things settle down, if we don't, whatever level of tariffs we end up with, okay, you can work with that. You know what the impact it's going to have. So that does suggest that, yes, hopefully later in the year we will focus more on fundamentals.
So I talked about some stocks that were outperforming. I said since April 2nd, I actually meant the last 9 days, but math is hard. But the point still stands. It's close. ServiceNow, Palantir, Vistra, and Arista. Vistra, obviously an energy company, and that's an AI play, but the rest are all tech, cloud, IT, software. And I'm just wondering, as we saw the rally unfold in the last week and a half, does the AI trade in tech still support U.S. exceptionalism?
I think it does. We are ahead. Those companies are leaders in AI space.
But I feel like there's a but coming from you.
The tech trade could also be, a bet that rates are going to come down, and they'll benefit more than other sectors. So it may be the AI trade, but it may also just be the general economic environment, particularly if the consumer pulls back.
Right, and then that's the consumer exposure. So will the U.S. get to keep all that cash that it's had over the last 20 years as U.S. exceptionalism has reigned? Will it stay here?
Well, the evidence so far is no, that, cash has already moved out. I think during that 9-day period or the period since April 2nd, what normally would have been a flight to safety to U.S. Treasuries actually went out of the U.S. to other bond markets, to other countries' equity markets. And so I think it would have to be something, I think, particularly exceptional to pull that money back in, at least over the near term.
All right, Melissa, great stuff and great to see you. Melissa Brown, Managing Director of Investment Decision Research at Simcorp, counting us down to those closing bells, which are just about 3 minutes away here. And we're closing out what has been a phenomenal run, not just obviously the 5 days, but that whole 9 days, the entirety of it. And this complete kind of U-ey that we've made from where we were on April 2nd or just before April 2nd to where we are today.
And I wonder what the next catalyst is going to be after today. We got through 70% of S&P earnings. I know we have like Walmart and Target and Nvidia, but really what are we going to be waiting for? Is it the 90-day period come July for trade? Is it going to be the July meeting for the Fed? I mean, it feels like next week is off the table now.
And don't forget, Congress, too, is going to be a big factor as now their attention turns to the budget and tax cuts and things like that could, if they sort it out, be upside catalyst for the market. And maybe if they don't sort it out, downside?
true. But you can also make the argument there's a lot of mechanical buying that's still in place within the market rather than fundamental buying. So maybe there needs to be more unfolding of that, particularly when it comes to funds.
U.S. equity sitting on some pretty healthy gains for the week, about 3% across the board. A full breakdown of all of today's price action in all of the cross-asset markets starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele taking you through that closing bell. It's a global simulcast, and it starts right now. Scarlett Fu in the TV studio, Carol Masser in the radio booth, Emily Grafeo in today for Tim Stenovic as we welcome our audiences across all of our Bloomberg platforms, including that partnership with YouTube. Romaine? Feeling what number? What am I feeling? What am I feeling?
Outnumbered?
Tell me what I'm feeling.
Are you feeling outnumbered?
Oh, outnumbered?
Yeah.
No, I love all of you. Well, almost all of you. I won't tell you which one.
Uh-oh.
Wow, that's rough.
That hurts, man.
Interesting day here in the markets.
Joking.
Yeah.
Just differently.
That took a beat too long.
Yeah.
Well said, well said. S&P, as we know, as we all keep saying this, on track for its longest streak of gains since 2004. So big bounce here. It's almost like the tariff stress hasn't happened. It's not over. We know that, but what a reversal it feels like.
You know who's really not stressed about tariffs? The small cap issuers, because small cap index, Russell 2000, up over 2% today. And it was really rising after that positive economic data earlier this morning. All around risk on today.
Yeah, all around risk on. But at the moment, there's some technical analysts out there who still sees more clouds ahead. Tom DeMark accurately called the February top, the April low. And he says he sees another drop in the coming months that will lead to a bear market. So down 20% from the peak of the market.
And what I love about his call, though, he says that before we get there, we might actually retest some of the highs. And that kind of just shows you just how volatile this market is, that even with some of the more bearish calls on the street, they say, of course, the ride is not going to be linear in any stretch or of the imagination. As we get the closing bells here in New York, it is a solid day, green across the screen. We should point out, for the S&P 500, we're actually looking at one of the broadest rallies of the year. I think once we get the final tally, it might actually be at least the third broadest here in 2025. A gain of about 82 points or 1.5% on the day, and that's going to close out the week higher by about 3%. Similar gains on a daily and weekly basis for the other indices and averages. The Dow Jones Industrial Average up by more than 500 points or 1.4%. The NASDAQ up about 267 points or 1.5%. And the Russell 2000 gaining on the day about 2.2% and on the week higher by about 3%.
All right, quite a move to the upside. Just digging a little bit deeper into the S&P 500 today, guys. Broad-based buying. We'll see that more with Scarlett in just a moment. But 459 names in the S&P 500 gaining ground today. Only 44, Scarlett, to the downside.
Yeah, take a look at the IMAP. It's pretty straightforward here. Lots and lots of green. No red at all, at least in the 11 sectors here. The leaders in today's market, communication services, financials, both gaining at least 2%. Industrials up about 1.9%. The laggards are consumer staples and utilities, each down, or sorry, I misspoke, each up, not yet 1%. But that just gives you a sense of the defensives trailing and underperforming the growthy areas of the market.
A lot of green there. So a lot of choices for me in terms of gainers today. Do want to point out airline stocks. We saw them rallying along with the broader market after the latest batch of economic data was upbeat. We're talking about the jobs market we got this morning. So maybe assuaging fears that there was a U.S. economic slowdown coming, although many will remind us that maybe all of the data to come, we'll see how the tariff impact may come in future data points. Nonetheless, Delta among the top gainers in the S&P 500, a gain of about 6.5% in today's session. Your number one gainer, I should also point out Delta, after the close last night, authorizing a $1 billion share buyback repurchase plan. So I'm sure that certainly was at play. All right, to the number one gainer in the S&P 500, NASDAQ 100. We're talking about Dexcom. It was up about 16% in today's session, pretty much closing at its best levels of the day. Makers of glucose monitoring systems posted better than expected revenue for the first quarter. Analysts noting a recovery in U.S. sales. BTIG saying the beat shows Dexcom is, quote, back on track. Five Below, this plays into kind of the value retail space in a big way, up about 12% in today's session, so rallying. The company came out increasing its first quarter forecasts for sales and profit. Stock is still down, though, about 20% year to date. And
you know what I love about Five Below? You know they have all the different Haribo gummy bears, like all the different flavors.
Do they?
Yes.
Oh
it's
my
like
God.
a little dirty little
there.
secret.
Yeah,
secret's out now.
So you shop there often?
Yes, because he likes the Haribo gummies.
Just for that.
If you go by his desk around 7 a.m., that's what you're going to get.
Well, they are saying thank you, Romaine, for shopping there.
You do. I've seen you.
No, I don't.
Wait, gummies at
I
7
only
a.m.?
eat healthy.
I've seen it.
I never see him eat lunch, so this actually explains a lot.
Yes, there we go.
All right, moving along. Finley
Salads.
said I could have 4 gainers
Carrots.
today. Thank you, Finley. Duolingo up about 21%, so finishing at its highs of the session. Thank you, actually, Emily, because she brought this to my attention. Boosting its
Or should you
outlook.
be saying domo arigato?
Raised full-year sales and profit outlook due to the success of its AI offering. Sounds like you've been using it, Romaine.
Muchas gracias.
Anyway, the AI offering is driving subscribers to that space, and that's a higher subscription. So, yeah,
Wonderful.
good stuff.
All right, Emily.
All right, so Carol had 4 gainers. I'm just going to do 3 decliners, though. But those gainers were really wonderful. Apple
you.
down 4% on a day when pretty much everything else was up. I found these decliners, and one of them was, one of the biggest companies in the stock market. The iPhone maker reported China's sales were disappointing. They warned about the impact of tariffs, with Tim Cook saying that the planned U.S. tariffs on foreign imports will add $900 million in costs. We also got 2 rare downgrades on Apple today from Jefferies and Rosenblatt Securities, both turning more bearish on that stock than they were previously. I'm also looking at Block. Those shares sank as much as 24%. This is a digital payments company. They cut their gross profit guidance for the full year. And then the results also showed that their Cash App card spending unit came in weaker than expected, with consumers pulling back on spending on travel and entertainment. They were still spending, though, on those staples purchases like gas and groceries, but it's not a great macro read-through.
Do you use this
in
Cash
these
App, Emily?
results. I don't, but I do see the Block interface, like when you go to checkout on places.
A lot of
you
times,
kind of,
right.
You kind
Farmers
of see that.
markets and
Yeah, I guess it
things
used
like
to be
that.
Square, now it's Block.
Farmers markets, aren't you fancy?
Yeah, I am.
Yeah. So this is another company that I'm not familiar with. I don't know if any of you guys play video games. Take-Two Interactive. If you're superstitious, this was not a good number to end the day on. It was down 6.66%. Those shares were down today. The video game company delayed the release of Grand Theft Auto. It was supposed to launch this fall.
Yeah.
It's now not launching now. Grand Theft Auto 6.
Shocker.
Grand Theft Auto
Shocker.
6.
Next
There's
year.
been
Right, sorry, not
5
the
different ones.
actual iconic video game.
Wow.
But the 6th version is now not coming out for
Who
at
would have
least
thought
another
that
year.
would have been delayed?
Maybe they just got to make
Yeah.
it cooler.
Yeah.
That's the thing. I remember standing outside, doing the man on the street interviews for those who were lining up overnight to get the Grand Theft Auto. This was like 20 years ago.
The original one?
Yeah.
I thought you were going to say you were lined up out there.
No,
Looking
someone
to
being
buy
like,
Grand
tell me
Theft.
how you feel with the camera there. Should I go to yields? Should we go to yields, guys?
Go to yields.
do it.
All right. So it was quite an interesting day, actually. So obviously you get the headline number from jobs and you see higher yields all across the board. But particularly in the 2 and the 5 and the 10s, we're now at the level that we saw since the beginning of April. Not so much with the 30s. So that's, I think, a little interesting as well. But for the short end and then the belly, you're definitely seeing yields back to where we were from like April 9th.
It's like nothing
area,
happened.
guys. It's like nothing happened.
Except that so much did.
Except so much did, which raises the question, how do you then think about buying and investing when we get more of these whippy headlines then? Does that set you up more for buying the dip because we now know what it looks like when in a turbulent month?
Well, thank you for setting me up so nicely, Alex. Really appreciate it. A story that caught our attention here, it has to do with Warren Buffett's favorite valuation indicator that's flashing a buy signal. It's called the Buffett Indicator. It measures the ratio of the stock market's total value to the dollar value of U.S. gross domestic product. It's currently at its lowest level since early September, Emily.
Yeah, this is, I guess, signaling that equities are relatively cheap. Even after the rally that we've had, the valuation signals are looking pretty healthy right now. This is like a classic, signal that at least us on the print side of the newsroom look at.
One interesting thing, though, when I saw this, because there was another report out just the day before about just how narrow the equity risk premium is right now. When you take global stocks and you sort of put them up against what you would get in the fixed income space relative to that, I mean, it's still like the narrowest that we've had in several years, and that could maybe potentially be an impediment to future gains.
Do you think he's going to bring this up tomorrow at the annual general meeting of Berkshire Hathaway?
Oh, yeah, I thought you meant this conversation?
Not this conversation.
You're going to say, you know what Scarlet Fu
hold
said
on a
about
minute.
me
Warren's
yesterday?
calling, guys.
Yeah, exactly. By the
to
way, next Thursday, I don't know if this is actually going to happen, but next Thursday is VE Day, and President Trump has proposed making that a not necessarily a holiday, but designating it as Victory Day for World War II. And so a lot of people are wondering, does that mean we're actually going to get a national holiday at some point? And he wants to rename Veterans Day, which is November 11th, as Victory Day for World War I. He wants to, in other words, celebrate the U.S.'s role in ending both world wars.
I don't know where to go from there.
I don't know either.
Yeah.
Do you want an extra holiday?
I mean, everybody does.
Well, actually, we don't actually give out Veterans Day off anyway, though. The market's
It's true,
open.
and we clearly want to celebrate those for World War II. It's interesting when you wind up dissecting it into different wars versus just one day where we celebrate all veterans at the end of the day. And that is the end of the sign. Thank you for playing.
It's been a week. All right, that is a wrap, guys.
Wait, you guys are going off, right, to L.A.?
We are going to go off to Milken, talk to a lot of folks, certainly in the financial space and corporate space and political space. So we'll see what they have to say in terms of
the
optimism.
entertainment space.
And by you guys, we mean Romaine Bostick and Carol Master will be headlining, along with Sonali Basak, the great interviews from California and the Milken Conference.
Wow, see, Alex knows how to sell it. Carol, that was kind of lackluster.
I don't know. All right, that is a wrap.
She's tired from prepping.
Thank you very much. I am tired from prepping. That is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Folks, we call it the closing bell. We will all see you, some of us see you next week on Monday.
And our coverage continues right here on Bloomberg Television. A closer look at all of the market moves this week. A big jobs report that just dropped this morning and a big Federal Reserve meeting up ahead next week. Jay Barry, head of global rate strategy at JPMorgan, joins us after the break. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlet Fu.
And I'm Romaine Bostick. A wild week on Wall Street, but well, for a lot of good reasons, at least. The market really sort of tamped down some of its angst and fears when it comes to tariff and the trade wars. And that was, well, because we got a bit of a tamp down in some of the rhetoric from the White House when it comes to the tariffs and the trade wars. The S&P 500 gaining 1.5% on the day, and that solidifies a gain of more than 3% on a weekly basis. Second straight week of gains, and of course that 9-day win streak, the longest, going back to 2004. Dow Transport's having a great day, up 3%, largely on the back of some phenomenal moves in the airline space. A lot of those names up 7, 8, 9% on the day. And chip stocks also getting a strong boost, up 3.5% as yields now starting to drift back higher as I guess folks, Scarlett, they're starting to price out all those race cuts that were being priced in just a little while ago.
Yeah, certainly, at least for this first part of the year. Maybe in the second part of the year, it'll be a little bit different. But let's take a look at some of the day's big movers. We'll start with Dexcom, up 16%, the best performer in the S&P 500. The medical device maker posted better than expected revenue last quarter, and investors say they liked the recovery in U.S. sales and say that they see a lot of momentum there. We're looking at Block as well, down 20% on the day after cutting its full-year profit guidance because of the challenging macro environment. Also, its first quarter results showed weakness in its ability to convert active users into full-fledged banking customers, so not completely getting it done on that front. Now, our top story this hour is something that you referenced, Romaine. If you're waiting for the Fed to cut rates, it may be a while. Policymakers repeatedly have signaled that they need to see a deterioration in hard economic data before they can justify easing monetary policy. So by that measure, the April jobs report that came out this morning failed to deliver. It was stronger than expected, therefore reducing the odds of a cut in June to below 50%. That's after markets spent most of a roller coaster April expecting a June cut to be almost a done deal. Romaine?
Yeah, interesting to see the price action today in the swap space as a lot of people now try to jockey and determine exactly what the Fed will do later this year, if anything at all. Jay Barry joins us, head of global rate strategy at JPMorgan. And Jay, I do want to start with the moves in rates. It looked like we were actually heading for another drop on a weekly basis in rates, but obviously a big bump higher, certainly on the 2-year today, up 12 basis points, as a lot of people now are basically saying a lot of those Fed cuts could potentially be taken off the table. What do you say?
Yeah, I think that's exactly the case of what's happened, Romaine, and it's pretty incredible. If you look at it where we were versus yesterday morning, just after the jobless claims numbers, and two-year yields are almost 30 basis points higher. And I think really what we understand, and Scarlett was talking about it, from the Fed's reaction function, is that we need the hard data to weaken. And most importantly, we actually need the labor market data to weaken. So the fact that you still see pretty strong demand for labor, the fact that the unemployment rate was unchanged, even with the participation rate rising, that the work week extended, it all gives you the sense that this is not the sort of data that will allow the Fed to ease, particularly because we know the inflation data in the middle of the year will begin to become a bit hotter as the tariffs are implemented. So our view here at JPMorgan has been that the Fed will begin easing later this year, but that it will actually not be until September, because we'll only start to see the loosening of the labor markets as we get into the second half of the year. And I think that was the repricing that we've had over the last 24 to 36 hours today.
So if that is the scenario, if that scenario plays out as a tactical trade, does that mean you're selling shorter duration and buying longer duration, or vice versa?
So I think overall shorter duration instruments look pretty fairly priced right now. Markets are pricing in about 80 basis points of Fed cuts over the balance of this year, very close to our forecast. But I think beyond that, markets are pricing in less than 120 basis points of cuts in aggregate from now until the middle of next year. We think that's a bit underpriced, and as the growth data actually disappoints, as the labor market weakens, we think there's room for the front end of the yield curve to decline, and that's been a core view. But I think the rest of the curve, it's going to be a bit more of a challenge to see yields decline, even if the Fed eases and continues to ease, Romaine. Because I think what we've learned over the past 4 weeks, and this has been something we've been focused on for some time, is that we're in a world where we need to be comfortable with term premium being higher. And that's unlikely to abate anytime soon. So it's possible that long-term yields fall as well, but we think they're going to have a much lower sensitivity to changes in Fed policy rates than the front end of the curve.
We've got a lot of supply coming next week, especially at the short end of the yield curve, $165 billion in front-end loaded bond supply. What do you expect demand to look like given what we've seen today in terms of price action?
Yeah, I think, Scarlett, the fact that we've backed up the front end of the yield curve now, it probably means we're more appropriately priced. If anything, perhaps pricing in still too high a probability of a cut over the course of the summer, but we probably won't see that sort of probability change much until we get the May employment data a month from now. I actually tend to think with the way the front end has moved back higher in yield over the course of the past couple of days, that the front end supply shouldn't be too difficult to digest, if anything at all. Again, probably where I'd be more concerned about digestion issues is the long end of the curve. Because again, if we kind of consider how Treasury demand is in a slow basis shifting away from price-insensitive investors towards price-sensitive investors, it may mean it's harder to absorb these longer duration auctions without more of a concession.
You know, this week we, of course, and today in particular, we got signs that, tensions between the U.S. and China are easing, and maybe the two sides are headed towards coming up with a framework to begin trade discussions. What does that mean for U.S. Treasuries? Do you think that the market anticipates Chinese holdings of Treasuries to come up at all in any kind of trade discussions?
Yeah, I think it's a real question about whether they come up or not. And I think certainly we saw the comments from the Japanese finance minister overnight when he was questioned about Japanese Treasury holdings. But I think more broadly, Scarlett, the concerns over foreign changes or changes in foreign holdings in Treasuries last month, they're warranted because we know that the foreign share of the Treasury market's been declining, and it's been on a decline for the last 10 years. But to expect that there's going to be an acute short-term change probably seems unlikely because these sorts of institutions move relatively deliberately and strategically over time. But we know that it could be a powerful influence because I think, importantly, our work has shown every $300 billion or so of selling of treasuries from the foreign community would probably raise intermediate yields by 35 to 40 basis points. So whether it comes up or not, I'm not so sure, but certainly the markets are focused on it from a more medium-term perspective.
What does it mean, though, when we get to this, further issuance in the United States later this year, particularly against the backdrop of budgets that are now sort of being put on the table in terms of proposals and, in theory, within the next few months might actually be reality? Is this a situation where the U.S., one way or another, is going to have to pay more and, more importantly, also issue more?
Yeah, well, on the latter part of your question, Romaine, absolutely, the U.S. is going to have to issue more. And we think we're in a spot where the Treasury Department did enough work last year that it can keep coupon auction sizes unchanged until probably February of next year. But after that, there's a funding gap of something in excess, we estimate, of about $5 trillion that will need to be addressed, which will require more long-duration issuance. And I do think as the long duration issuance increases, as we continue to run budget deficits that are 6 to 7% of GDP against the backdrop of that shift in demand that we've talked about, that's just going to mean that yield curves are going to be steeper for a given level of policy rates than we've observed in the past. So necessarily, I think we just need to be comfortable with that steepening, and that's been the trend for the last 6 months or so, should be the ongoing trend of the Treasury curve for the medium term.
All right, Jay, always appreciate your joining us and sharing your insight. Jay Barry is head of global rate strategy at JPMorgan. Now, next week, Bloomberg TV and Bloomberg Radio are speaking with the biggest names in business live from the Milken Conference. Romaine and Carol will be there along with Shanali. And some of the folks they'll be speaking with include Robin Grew of the Man Group and Stephen Tannenbaum of Golden Tree Asset Management. Be sure to keep it right here on Bloomberg for that. This is The Close.
Next week, Bloomberg Television and Radio are live from the Milken Conference in Los Angeles, speaking with the biggest names in business about the top issues for investors. Live coverage begins Monday at 2 p.m. Eastern on Bloomberg Television and Radio.
We are gearing up for another week full of earnings with the travel sector a key focus. Marriott and Expedia are due to report next week following a slew of results already out from Booking, Airbnb, and Hilton. So joining us now to discuss is Hayley Berg, lead economist at global travel platform Hopper. Hayley, the big question, of course, for all these companies that report is the guidance and their visibility 3, 6, 9 months out. Given how resilient travel demand has proven to be in past downturns, what do you expect the narrative to be from the companies that do report?
You know, we're continuing to see most of these companies report some form of uncertainty. We're not sure. We're waiting to see. And I do expect that that's going to be the party line for the next couple of months, at least, until we see where the economy goes. The softer metrics we have, like consumer confidence, are showing weakness already. But many of the airlines have reported stability, an initial drop earlier this year, but stability in the last few weeks. So that guidance, I really anticipate, will remain up in the air. The good news is that summer is the biggest season and the longest season for travel providers. So we're going to gain a lot of data points over the next 2 months or so as all those summer vacations are booked and we see what the advances in the prices look like.
We know that there's less inbound travel from other countries, Canada, Europe, because of what's been happening on the trade front. What do you anticipate it to look like, the international travel from the U.S. to other countries over the summer?
You know, we're really expecting a strong international summer, despite some of the weakness we've seen in main cabin domestic over the past couple of weeks. Part of the reason why is because younger generations are just prioritizing protecting that travel expenditure much more than older generations were. And they're also much more interested in international trips. I look at travel to Europe, travel to Asia. You know, they're capturing an incredible amount of demand from travelers searching and planning summer vacations right now. So even if we see a downtick in that maybe 20% of the cabin that's typically booked by non-U.S. origin passengers, I do expect a lot of that is going to be filled by U.S. passengers who are interested in heading to these international destinations this summer.
With regards to just sort of what people are booking in terms of the levels, are people splurging on whether it's being in a first class cabin or going for that, nicer suite on the ship or, just a bigger hotel room at the resort? Are we still seeing that, or are you anticipating that maybe we'll see people rethink that and just be happy with what's second?
Premium is here to stay. We're continuing to see, even in this bit of a slowdown, that premium economy seats ancillary products that are a little bit more expensive but add comfort and convenience. They're still flying off the proverbial shelves. We did a survey at Hopper and HTS, and we found that 2/3 of Americans say that they skip the cheapest flight option. It's an easy example because it's named premium. Many of them are going for that premium option, preferring a combination of quality and convenience over just getting there for the smallest amount possible.
With regards to some of the programs that the airlines, hotels actually use to sort of keep their customers tethered, do you think that they need to rethink maybe some of the incentives in order to sort of keep things sticky if you are under the assumption that we are going to see maybe some potential broader economic pressures?
Loyalty programs are going to be key. And I think we heard that from most of the major travel providers who have reported in the last few weeks that earn and burn programs are going to be a key focus because they do generate stickier customers who come back to spend those miles, those points, get their free nights. We're increasingly seeing travelers are booking through whether it be a credit card rewards portal or another travel rewards program because they can earn, they can spend points, and they can push that budget a little bit more. These points, they're not coming out of your bank account. They're not going on your credit card bill. So optically, for a lot of travelers, earn and burn programs and being able to use all of those rewards towards travel, it's exactly what they want to be doing. It's really shifting their volume to these new channels.
Hayley, got to leave it there. Hayley Berg, lead economist at global travel platform Hopper. A closer look here at some of the travel trends ahead of some big earnings reports scheduled for next week, including out of Marriott as well as Expedia. Also next week, we'll be on the ground in Los Angeles at the Beverly Hilton for the Milken Global Conference, once again, where the biggest names in business talk to us and just us. Manny Roman over at PIMCO, Armin Panosian over at Oaktree, just among some of the big executives in the world of finance who will give their thoughts on the health of financial markets and the health of the global economy. All that coming up next week, right here on Bloomberg. All right, the health of the consumer remains in focus with the barrage of economic data and corporate earnings and concerns about higher prices from tariffs. A new survey out from AlixPartners shows that almost 80% of shoppers are actually walking away from a shoe purchase because of the costs. The firm saying that tariffs will impact the entire business, starting with cost and margin, price to consumers, and pricing strategy. Bryan Eshelman joins us right now. He's Senior Retail Operations Executive at AlixPartners and the former COO of Aldo. So you know a lot about shoes. Talk about this survey, because I guess I was shocked, but I also wasn't shocked. It seems the primary reason is a lot of people are saying that shoes are too costly, and obviously if economic times are hard, this becomes the ultimate discretionary item that they get rid of? Don't we still need shoes?
Yeah, we still definitely need shoes.
Yeah.
But, as people feel, pressure on their discretionary income and their ability to spend in general, they're starting to cut back in ways that we haven't seen before in prior versions of this survey. I mean, in fact, even in athletic categories, they're buying and expressing an intent to buy less shoes, fewer shoes this year. I think they have a lot in their closet, but this is starting to become a want, not a need, in the minds of many consumers.
This gets to a sense, though, too, about where pricing was, right? There had been a lot of criticisms that, particularly in the athletic footwear space, there have been some very aggressive pricing over the last couple of years, primarily capitalizing on trends.
Yep.
Does this mean that maybe we see more discounts going forward if consumers do pull back?
Well, I think the fall and holiday season is going to be highly promotional. I think there's going to be a lot of that activity for sure. Consumers are not dumb. They understand that tariffs will, in fact, raise the price of goods. And we saw that 80% of the respondents in the survey understood that. They see the connection between a tariff and a raised price. So those that are intending to spend more on shoes this fall really think it's because they're going to be spending more in price, not in number of pairs.
You mentioned that people are also not looking to spend on athletic shoes. What are they willing to spend on when they do spend on footwear then?
Yeah, I think the categories that really should be of focus for footwear companies and retailers, really specialized footwear for activities, hiking, doing anything that requires something that's specialized in nature, and then travel. We did a global consumer survey, and one of the only categories of spend that we see people not cutting back on globally this year is travel. Groceries was the other one. So if you can connect, a shoe purchase to a trip or a travel in terms of the marketing that you're doing to your customers, that's another, potential tip for the fall.
Sounds like a big market for comfort shoes. So what would be the advice that you would give to footwear makers? How would they position for this, given what you've just heard from this survey?
Yeah. So I think first and foremost, know what you're up against. If they don't know their exposure to the tariff regimes that are in place or coming, really understanding and quantifying that, and also that of their competitors. It's public information who direct imports what, and so you can, in fact, find that information out, and that's important for pricing. I think planning for the worst, making sure your balance sheet is in shape for the fist fight that's going to be this fall holiday season, and scenario planning what options you have depending on what happens.
What does that scenario planning look like? I was having a conversation with the head of another large retail chain, and they were almost basically talking about, they're basically doing like Monte Carlo analysis at this point, something that they had never done. I mean, how do you advise a client in this environment? Because it's not really about what the tariffs will be. It's really about the idea that no one knows what they will be. So when do you order, you know, your shoes for the next season? Well, how confident can you be that you're going to get them at their originally agreed upon, you know, shipping costs and manufacturing costs as well?
Yeah, I mean, the lead times of footwear are such that everything by now for the rest of this fiscal year, by and large, has been bought, right? Yeah. So the decisions that retailers have been making over the last few weeks is to cut, delay, or cancel those orders, but without a really good crystal ball, right? So I think there's so many variables at play here, everything from the macro environment and what's going to happen with the consumer to what will happen with tariffs, to what competitors will have in terms of inventory or not having inventory. And so mapping those out, I think, is an important thing to kind of game theory.
But is it going to be harder to do that in a world where shoes are much more about fashion and we know trends can change? So if a company is shipping in a bunch of stuff now that may not end up being able to sell, at least at a price they want to sell, are they at the risk that at some point time will just pass them by and those shoes won't be as cool or as in demand when the times do get right?
Yeah, I think that's a risk. I mean, certainly, you know, basics and core product is really the right thing to focus on. Those are lower risk. But fall product that doesn't sell this fall can be put away and sold next fall. So it's not a complete lost cause if you make the right decisions.
Right.
What will store shelves look like? I mean, is there going to be a lot of selection or not enough selection? Because we keep hearing about how there's a lot of ships that are not coming into port because none of the companies can take in the deliveries right now. So at what point do the store shelves become something difficult and people can't find what they need?
I think it's going to be really piecemeal this fall in terms of what's available and not, because, you know, so much of the production comes from Southeast Asia, and the timelines and the shipping costs and everything else are going to skyrocket. It's going to be difficult to get goods here on time, for sure.
All right, Bryan Eshelman, Senior Retail Operations Executive at AlixPartners. He is also the former COO of Aldo. And we talk about what store shelves will look like. Christmas may be months away, but one business is already warning that consumers will be feeling tariff shocks hit during the holidays when it comes to gifts and when it comes to decorations. So as a result, our next guest is asking for a 90-day pause on China tariffs. Mac Harman is the CEO of Balsam Hill. It is one of the biggest retailers of artificial Christmas trees and holiday decor, and he joins us now on set. And Mac, to be clear, most of your products are made in China. Artificial Christmas trees, all in China, right?
87% of all Christmas decorations come from China, and quite a few of those are artificial Christmas trees. It's the largest place. They've started to move to some other countries in the past few years, but the majority still come from China.
And during the first Trump administration, those products were exempt from tariffs on China, but this time they're not. What was the explanation given to you, or based on your understanding?
Well, in the first set of tariffs, everything in Christmas was tariffed, and a number of us worked hard to try and get them put on the list that had a 0% tariff. So pre-lit Christmas trees had a 0% tariff, but string lights, the lights you put on a farm-grown tree or put on your gutters or your bushes, those have a 33% tariff. As a result, with 145% tariffs now, string lights are actually at 178%.
Ouch.
Can you just buy that stuff now and get it into the United States before that sort of tariff curtain comes down? So assuming that it actually they follow through with this.
Well, many of us did that. We brought as much inventory as we could for this Christmas in before Liberation Day. We brought it in before the inauguration, just in case. But that stuff is here. Maybe we have 20% of the inventory that we need. And every day we have containers arriving that are getting tariffed at 145%. It's a $13 million bill for us for containers that were already on the water that we couldn't stop when the announcements were made.
With your consumers, how elastic are they in terms of their ability to maybe absorb some of that cost, assuming that you're basically stuck with it?
I think there's probably some elasticity, but there's not a lot. And we actually did an experiment in February where we raised our prices. Back then the tariffs were 10%. We raised our prices 10% and our demand plummeted. And believe it or not, people buy Christmas trees in February. Now that's probably the bargain shopper, and so maybe they're, less willing to take a higher price. But, we have to pass on about 90% of the tariffs for us to break even financially as to where we were before the tariffs went into place. So with an over 100% tariff, you can imagine, I don't think consumers are willing to pay 100% more.
Did you articulate why you raised prices to the consumer?
We did not. No, that was just a blind study we did.
Just curious. Okay.
Yeah.
So, Mac, you're based in the Bay Area, and normally you're there, and I know you travel a lot to China and stuff, but you're here on the East Coast because you were just in Washington and kind of making your case. What was that like? How receptive were policymakers to your pitch?
Well, I think what I learned is that the speed of business is really fast, and we're all expecting these deals to happen quickly. And what we heard from the administration, we were in the Department of Treasury, we're in the White House. It takes a lot of time and effort to have two governments come together and craft a deal. And so I walked away from that appreciating there's a lot of work that has to be done. It's going to take time. And that's really where the idea for the 90-day pause came from, because it's going to take more time, I think, to get to a deal than we have before. Like right now, Christmas good production has stopped in most places because the manufacturers don't want to produce it because they're worried they're not going to get paid. They get paid when it ships.
So your suppliers have stopped producing things?
Most of our suppliers have stopped producing things in China, virtually all of them. And we also have stopped shipping things. We have over 150 containers of finished goods sitting in China that we have said, please don't ship them because we need the cash to pay these tariffs. And again, to your point, I don't think consumers want to pay double for their prices. And so everybody in the industry is kind of waiting. It's like driving a car towards a ravine where the bridge is closed. We're hoping that bridge opens before we get there. We've taken our foot off the gas. We stopped investing. We're cutting expenses. But we're just kind of going 55, hoping that the administration gets that bridge laid down. And we think that this 90-day pause will really create the space to do that. It also let us repatriate cash because we've put millions of dollars into this inventory because you have to put down a deposit when you buy things. So hundreds of millions of dollars could be repatriated for American companies that have it sitting in half-finished or finished goods that they can't afford to ship in. So I think that would be a real win.
If there isn't an amicable solution, what are your options in terms of changing where you source your products? Is there a viable one?
So not in the near term. We have started shifting over the last 5 years. One of our big manufacturing partners has opened facilities outside of China. We are going to have some goods that come from that market, but it's just a fraction of what is needed. And it's going to take time for the investment to pay off. Plus, everyone's waiting to see where are the right countries to invest because we want to see what their trade deals are. So it's hard to place a bet on where to invest right now.
Do you see any option to bring some of that back to the U.S.? Because, of course, this will be the administration's argument that if you want to avoid tariffs, then just make your stuff here. I know that's a very simple argument, but that is their argument.
It is. And it's interesting with pre-lit trees. They've never been made in the United States. Artificial trees that were unlit were made here, but pre-lit ones, there's so much labor putting the lights on that it's never been here. We looked at this a few years ago. We hired a great design firm, the firm that invented the mouse, to look at this and see if we could do it, and it just wasn't there yet. And so maybe in some number of years with AI somehow it'll be available, but the precision of putting the lights on in the right places and doing it when the branches are in lots of different places, it's just too much right now for automation.
All right, good stuff. Matt Harman, CEO of Balsam Hill, thank you so much for joining us, and we'll check in with you as the months go on, certainly. All right, let's take a look at how markets closed on the day. Another week of gains here for U.S. equities. Look, the S&P 500 closing up 1.5%. We have now made a full recovery from those April 2nd losses.
Yeah, we have. Of course, not a full recovery from those February highs, but it gets to this idea as to just how much further this can go. If this was indeed a sell-off from the start that was about tariffs and trade, then a tamp down of the rhetoric maybe gives you some sense here of why it could go higher. But we were talking a little bit earlier during the simulcast that when you look at technical levels, when you look at corporate fundamentals, and if the sell-off was also about that, then maybe we might be hitting a ceiling sometime soon.
Well said. And big moves in Treasury yields. The two-year yield moves up by 12 basis points because that better than expected jobs report does push out the prospect of Fed cuts even further into the year. This is the close on Bloomberg.
Welcome back. Keeping an eye on the housing market with U.S. mortgage rates declining for the second week in a row. That is a positive sign if you're out there hunting for a home and you've been held back by any of those economic concerns. And despite those concerns, our next guest actually says that the luxury housing sector continues to show resiliency. Mauricio Umansky is the CEO and founder of the agency, a global luxury real estate brokerage that sells high-end properties around the world. Pleased to say he joins us right now. Great to see you, Mauricio. How's business been?
Business is all right. It's been hanging in there. We've been in a, real estate in general has been in a 3-year home recession, as everybody knows. But we're hanging in there, and we're doing our best. The luxury market somehow continues to stay good and resilient to everything. But we're definitely on a 3-year low here.
You've specialized primarily in sort of the luxury homes, and you're dealing with the clientele that in theory would be a little bit more insulated from economic conditions. But just because you have the money to spend doesn't necessarily mean you're going to spend it, Mauricio. And I'm wondering if you've heard anything from clients and potential clients about maybe just kind of sitting on the sidelines for a while.
Including the luxury buyer, the affluent buyer, the person that has the cash and everything available, they're sitting on the sidelines. They have 100% been sitting on the sidelines. And the reason they're doing that is because there's a perception that prices are going to start dropping. And they have recently started to start dropping. And so now you're starting to see there's been a little bit of a lower mortgage rate. The interest rates have dropped a little bit. The inventory has risen a little bit. Demand, there's a pumped up demand that's been, sitting around. And so you're starting to see the buyer come back into the market now, that they're starting to see a little bit of the market drop a little bit, the prices drop a little bit, more affordability. Because even if you have money, you still want to get a good deal. You don't want to be the guy that goes into the country club and everybody says, look how much he paid for, the property.
Absolutely. What about sellers? Are they willing to bring their prices down, or proactively, or is this something that they need to be convinced into doing?
The sellers, every seller thinks their house is the best house on the planet, right? That's just the universal thing. So they always have to be convinced to bring their prices down. And we have to do that, through data, through reality. But at the end of the day, the data shows that when a seller reduces their price, the house sells. When they reduce it to a price that is market value, the house sells. When there's a perception of value, the house sells. So it's all about that. There's still lots of buyers. And it just, at the end of the day, we still have to do a good job at convincing the client and showing the client, what they need to do.
Yeah. So, Mauricio, I also want to get a sense of what the market turmoil in the first 2 weeks of April meant for activity. Did you see a noticeable pullback or pause in activity on the buyers' parts? Perhaps they withdrew some of their offers, given the craziness we saw in markets for those 2 weeks?
There were two things that happened. You saw buyers that were in pending contracts sometimes cancel. So there was a lot of cancellations of existing contracts, and there was a very much slowdown of new contracts, new pendings going into contract and moving forward. We have seen ever since then, as we've seen the markets recover, we've seen that resilience, and we have started to see the contracts increase again a little bit. Affordability has allowed that. Lower interest rates has allowed that. And again, there's just really a pumped up demand.
I have to ask you, Mauricio, you are out there in Los Angeles, and of course, just a few weeks ago, we were all absolutely just awestruck by the damaging fires that we saw sweep through, particularly in some of the wealthier communities there in Malibu, et cetera. I know there's been a big rebuilding process that still has to take place, but I am curious as to what types of distortions the fire and the destructions of those homes has done to the broader housing market out there in the LA area.
It's a lot. I mean, I can tell you in the Palisades alone, 1 month after the fires, there were 0 sales. 2 months after the fires, there were 9 sales. And the third month, there's been somewhere around 17 sales, plus or minus. We are seeing these properties sell at a huge discount, 20 to 30% discount. And the reason that's happening is because there's a feeling that these communities are not going to be habitable for 3 to 5 years. Even though there's cleanup happening right now, there's just a lot going on. We're taking the power lines and we're putting them underground. There's a tremendous amount of work. I got to tell you that the one of the things that it's doing is that the Army is doing a great job at the cleanup. We're starting to see really a lot of people doing a lot of things, but we're in for a long haul. That we will not be able to forget about this. Hopefully, the Pacific Coast Highway is still closed for everybody that's not a resident. So you're seeing the businesses in Malibu suffer, the restaurants, the businesses, the real estate markets suffer. So until we can get PCH open, we're not going to see any increase there either.
Yeah, thank you for sharing that. It's a devastating, to see the destruction that was wrought in that area. I want to end things with you by asking about cash transactions. You did mention, Mauricio, that rates have come down, so it's made it a little more palatable for people to make their offers. But cash transactions have certainly picked up when rates did get elevated. And I'm wondering how much of a discount people expect when they make a cash offer.
Yeah, everybody that's making a cash offer, it's a buyer's market right now. That's the bottom line. And the people that have cash is king. That's what we like to say. So the people that have cash want to get a deal, and they're wanting a discount. And on these luxury properties like the one that you're seeing right now, we're looking at, the prices have dropped from the height, somewhere around 15%. I think there still needs to be a little bit more blood and a little bit more drop in the prices in order for the market to really start picking up steam again. And you're starting to see that happen. Sellers are starting to understand. They're seeing their houses sit on the market for too long. They're lowering their prices. They're seeing their competitors lower their prices. And as soon as they lower the price, the house sells. And so there's always that price. So we're starting to see a lot of that.
All right. Thank you so much. Mauricio Umansky is CEO and founder of the agency, joining us from Los Angeles. Ramin?
All right, it's going to be, we're wrapping up a busy week here at Bloomberg, potentially a busier week next week, of course, with the big Fed meeting on tap. We're going to have live coverage from the Milken Global Conference out in Los Angeles, where we're speaking with the biggest names in the world of finance, the biggest names in government, entertainment, and beyond. That coverage starts on Monday morning, right here on Bloomberg. All right, as we wrap up a busy week, we push ahead to what markets will have their eyes on over the next week. And when that starts with our coverage live from Los Angeles, the Milken Institute Global Conference 2025 kicks off with conversations with the heads of several of the biggest financial institutions out there. Jane Fraser at Citi, Manny Roman over at PIMCO, Mark Rowan over at Apollo, and so much more. All of that all week long.
All right, we're looking forward to those incredible conversations. And of course, they'll be talking about the state of the world. We have Scott Bessent, the Treasury Secretary, testifying both on Tuesday and Wednesday before separate House committees. So everyone's going to be listening for any kind of progress, any kind of update on trade talks.
Yeah, of course, everything that coming out of the White House's mouth, out of that administration's mouth, is certainly going to be something that the market will certainly have their ear to. But remember when Jay Powell used to be the guy that the markets listen to all the time?
Right,
remember him? Well, guess what? He's asked to make an appearance this Wednesday coming up here. A big Fed decision, and more importantly, a big Fed press conference. Expectations for no change in monetary policy. But he's certainly going to be asked about when they're going to change monetary policy.
Absolutely. And given this week's jobs report, he's probably going to say that they feel comfortable with where things are right now and commit to not answering anything. Yeah, certainly the data this week certainly might have given him a little bit of cover. We do get some consequential earnings, including out of Disney and Uber on that day. On Thursday, we get more earnings, including from Expedia, Coinbase, and Maersk, and another rate decision. Yeah, the Bank of England will be announcing its rate decision on Thursday. So, of course, we'll be watching for that, 7 a.m. in the morning. And then on Friday, China trade data drops, which will be interesting, of course, because of concern over how much the economy is slowing there. A lot to cover right here on Bloomberg Television, and we do hope that you join us all week long. Our coverage starts early on Monday morning from Los Angeles. This is Bloomberg.